This is Robert Kraft, and I'm your host on SNN.Network. And joining me right now is Drew Bernstein. He's the co-chairman of MBP to talk about a topic that's got a lot of news this year. So I'm really excited to have him here right now. So Drew, thank you for joining me today. How you doing?
Hey, Bobby, great to be back with you. Thanks
It's
for
great
having
to
me.
it's great to have you back. Real quick, how you holding up? Everyone's good. Everyone's safe.
Everybody's good, holding up right now, waiting for this to be over,
Uh,
let's get back to work,
yeah.
normal. Well, whatever the new normal is going to be.
Well, look, I know we all want to get back to work, but at the same time, I know you've been plenty busy, and especially with having the topic that we're talking about today, which get to it, SPACs.
Wow.
So,
What a year.
all right. So I want to start off with one of your blog posts that you actually posted on October 5th. And as the title in that article suggests, this has been, and I quote, the year of the SPAC. So let's
Yes.
start. Yeah. So let's start with a quick definition of SPACs and why thus far, and I quote here, thus far in 2020, 116 SPACs have been funded through initial public offerings, raising $40 billion. So SPACs, let's hear all about
Actually, we're talking about it today because the number is actually today closer to 60 billion.
it. Mm.
And over the last few years, I mean, we typically used to see maybe 4 or 5 billion a year raised. And all of a sudden we're seeing, this astronomical number right now. So, that's why we're here talking about it today. And that's why I wrote the articles. The SPAC is an abbreviation, obviously, for a special purpose acquisition company. And the history of the SPAC actually goes back to as early as the 1800s. It used to be called the Poor Man's Equity Fund. But then we saw sort of the reemergence of the SPACs in the 1980s. Early Bird Capital did the first, what we used to call blank check companies, because the SPAC actually had its orientation in penny stocks. And what happened in the 1980s is we had this Rule 19 come along, which started to put regulations on the penny stocks. And Early Bird Capital was the first one to really come out with a blank check company that raised over $5 million and $4 a share, met the requirements, and was able to circumvent not circumvent, but was able to do a public offering in accordance with Rule 19 that was essentially a blank check company. So that's kind of the history of it. And then it took off again in 1993. And then it's been around since then, but we've never seen the kind of funding and use that we've seen in 2020.
So, so you kind of went through the evolution of SPACs right now, and but really, I mean, how did we get to where we're at today? Why right now are we seeing, as you said, correctly on my number here, we got to get it more up to date, right? Is why are we seeing now 60 billion that's been funded thus far this year alone?
Well, I think it's a number of factors. One, when we talk about companies today, we're not talking about any companies, we're talking about unicorn companies. Now, it's a common term today, but the term was first coined only, I think, in 2012 or 13, when at the time there was 39 of them. So fast forward 7, 8 years later, there's just short of 600. And of the 600, 80% of them are US and Chinese, split almost half-half. So we're in the age of unicorn companies, and each one of these companies potentially is raising over $1 billion. We just saw Ant Financial, which got pulled back, that was looking to raise 34.5 billion, and the deal was 284 times oversubscribed. So I think, one, SPACs need targets, and there's a target-rich environment right now. And there's something in a SPAC almost for everybody, meaning for the investors and for the companies. So, and there's a lot of capital around right now that needs to get deployed. And I think SPACs have been one of these new vehicles, or not, they're not necessarily new, but more in use today than before because they offer a lot of things for everybody.
So then, now that you talk about how it's been a target rich environment, I mean, does this have to do with the pandemic and going through COVID
No,
right now? It has nothing to do with that. This was just,
no.
it just so happens that it's target
That's
rich.
well, these companies have been growing every year. Last year, there was probably less than 400 unicorns. So, the companies are growing. Some of them are growing because of COVID. Some of the fintech companies and tech companies. So, COVID has had a positive impact and also a negative impact on other companies. But when you think about it, one of the most interesting things about the SPAC, as you know, I work in China. It's where I spend most of my time. And it's kind of difficult to talk about SPACs without talking about China because that's half the targets right there. And if you recall, one of the things that the Chinese companies used prolifically was the RTO, if you recall. Well, a SPAC can actually act like an enhanced RTO,
Right.
if you think about it, right? Because what are companies, not just Chinese companies, but any company, what were the enticing factors about an RTO? Really two main things. Number one, at the end of the process, you were guaranteed to be public, right? Unlike an IPO, where there was risk, right? The other thing about the RTO is you were able to complete one in say 3, 4 months, 5 months, maybe, whereas an IPO could take 6 to 9 months to do. So it was quick, right? Well, a SPAC actually does that. To complete a SPAC deal, you can complete a SPAC deal in 3 months.
Right.
The other nice thing about a SPAC deal is think about it from the company's side, they get pricing up front, no risk of going to the market.
Mm-hmm. So
Right?
then, yeah, I mean, the
So
interesting
there's a
part.
lot of enticing things about a SPAC for both investors and companies, because don't forget, investors are looking for good targets, right?
Mhm.
Well, half those targets are in China.
So Drew, let me ask you a question then. Because this is the part that I've done I have another show called the Investors Roundtable, and we dedicated a whole episode to talking about SPACs. And one thing that I still had a question even coming from that is, what does this mean for the IPO market? I mean, SPACs, it's no secret. Like, this has been
No,
around
no,
for a
no. Look,
while, right? Like,
no,
so
no. I
you,
understand what you're saying, Bobby, but think of it this way, simply. We've gone through COVID. A lot of companies have lost money, right? So they need capital. Many of these, if not many, most of these unicorn companies have business platforms based on growth and innovation. That takes a lot of capital, right? So you can see right now that people want to invest in companies right now, and they're looking for vehicles. And when SPACs were raising 3 and 4 and 5 billion, they weren't really an option because that could be one deal, and that's the whole SPAC market. But with them raising 60 billion, and we haven't completed the year yet, it's like a new bank in town, right? That has different criteria, and it's a different source of capital, and it's another choice for the IPOs of where to go.
Mhm.
So I think for the companies right now, it's great because it's like a new bank in town that just opened up.
Fair enough. All right, so I want to dig into a few questions that were related
Sure.
to not just that blog post that we're talking about, but also another one that you posted a little bit later in the month. But one question I have for you is, what would you say are the unique features that management needs to be aware of when evaluating a potential deal?
Well, look, when you're gonna first of all, if you're going to do a deal with a SPAC from management, you have to understand that these are extremely sophisticated people. And you really need a good team to be able to do a deal with a SPAC. Because one of the downsides about a SPAC is it's sitting on a clock. When you raise money in a SPAC, the SPAC has, no more than, say, 24 months in order to deploy its capital. So if you can imagine you're a company and you're not able to produce the financial statements and information that a SPAC needs, you could potentially cause the SPAC to collapse where people would call back their money. So one, you really do need a crackerjack team, financial team, to be able to do deals with SPACs, because there's a lot of things that you have to know. For instance, you do a SPAC, founder shares. Typically, a founder, retains, say, 20% of the shares. Now, the founder does not have that 20% is not an interest in the trust fund. But the minute that that company makes an investment, your shares as the investor are diluted, right? So you want to make sure that the investments are investments where you can be able to cover the dilution. So there's possibility, there's reputational risk. A SPAC will do many acquisitions, typically 5 or 6. So if a SPAC does an acquisition that's maybe not popular, there's the association and reputational risk, right? That you can, that you will encumber yourself with. As I said, you're on a time clock to close. So you have to know that you can be able to do stuff like that. And also, probably the most important part is there's the risk of investor rejection. One of the nice things about a SPAC for an investor is there's an out for them. They can actually vote on the transaction and they can actually withdraw their shares. So one of the downsides about the SPAC, if enough people withdraw their money prior to the closing of the transaction, they're not going to have enough money to close. So I think there's a lot for management to be aware of. And like I said, it's not something they're going to learn overnight. So if you're going to do a deal with a SPAC, you better have a crackerjack financial team.
Very good. So you actually started answering a little bit of my next question there, because there's a lot of best practices that these management teams should probably be aware of, and especially talking about, at closing and then preparing to go public. I mean, is there anything else that management should be aware of from a best practices perspective throughout the whole process?
Well, look, credibility is the name of the game. Whenever I speak to public companies, the first thing I tell them is that if you want to be a successful public company, at the end of the day, you have to be able to own 80% of your investors' trust and confidence. If you can't do that, no matter what your company does, investors are not going to trust you. That's where sometimes you get, in China years ago, we had what we call the China discount, right? And what was that? Well, that was a discount that was tacked onto companies because people didn't trust their financials. So no matter what companies we're talking about, whether it's a SPAC, IPO, RTO, I mean, good corporate governance and operating with solid fundamentals, there is absolutely no substitution. And that will, at the end of the day, dictate your success or failure.
I think that's probably the best advice any manager listening to this right now could possibly take from this interview. But before we finish up here, to close out, what would you say is the end game for SPACs? Will SPACs become a viable alternative to the traditional IPO? The question you posit in one of your blog posts, actually.
Yeah, well, I don't have my tarot cards handy, but they are now.
I told you to bring the tarot cards. Why didn't you bring the tarot cards for this one? Come on.
Listen, accountants are probably one of the worst at predicting the future, right? Our expertise is just recording history. We're really bad, with predicting the future. But it's not a prediction anymore because they're here. Look, I think the objective for the SPACs right now, I think, is, they're still carrying a little baggage, because historically SPACs didn't have the kind of returns that people expected. They actually had historically relatively poor returns. And I think now, given the size of the money that's in the SPACs right now, if they're able to produce competitive returns with IPOs and stuff, then they're going to be here to stay. If they don't, because look, at the end of the day, even when a short attacks a company, how do they know when they're wrong? Well, they know when they're wrong when the company makes money and is able to operate with solid fundamentals, right? So I would apply the same principles to the SPAC. If they're able to produce good returns to investors and operate with solid fundamentals, then they're here to stay.
There we go. I think that's a great way to end it. So with that, Drew, where can our audience go and find everything they need to know about MBP?
You can go to our website at markhumbp.com. Free to email me, drew.bernstein@markhumbp.com, or give Bobby a call and I'm sure he'll pass it on to me.
Of course I will. You know that. Well, Drew, thank you so much for doing this. I really do appreciate you taking the
Thank
time.
you so
And
much for having me today. Hugs to your family. And thank you again for having me and the opportunity.
of course, thank you, Drew.
Okay. Thank
Bye-bye.
you. Bye-bye.